Okay, so good morning, my dear future chartered accountants. Hope everybody is doing great. First of all, can you please confirm that my voice is audible and the PPT is visible? Yes? Okay, thank you. So we finished with portfolio management. Now we are moving towards a new chapter, mutual funds. A very simple chapter, but somehow Institute knows how to complicate it. And practically, after you start earning, once you start stock market for investment, mostly you have to look for mutual funds. So what is mutual funds? How does it work? What are the ratios that we have to calculate? Who are the parties involved? And what are the evaluation that we can do? What do you mean by NAV? And what do you mean by dividend reinvestment? We also have concept like dividend equalization fund. Things like that we have to understand and solve. So initially, just like any other chapter, we'll try to take an overview and then we'll go to the specifications. So essentially, mutual fund is a fund. What do you mean by fund? It's a pool of funds. Many people come together and invest. Pool of funds. And that money will be invested. What is the reason? Why is this required? Uh, how it is evolved over a period of time? See, you become chartered accountants. After passing exam, most of the CAs at least will become auditors, will join a company, they become tax experts. Only very few can become stock market experts. Even you believe, let's say you understood SFM beautifully, I hope you're understanding, but let's say you have understood the SFM to the fullest extent possible and you start joining an office or big four or some industry. You know about the mutual funds, but you're in the taxation field. I mean, you know about the SFM, you know about the stock market. Even if you're an expert, you may not be able to pick the stock correctly. Even if you pick a stock, you may not be able to do a continuous evaluation because you have to track the news. One thing I should confess, or you should also realize, you have 8 subjects, right? Which is the most dynamic subject that you can have, or which is the most ever changing subject. Some people say direct tax every year changes. GST say what yearly, every 6 months once, every 3 months once. Whenever the GST meet happens, we change. Company law, whenever a circular come, it change. Income tax also we get circular. Accounting standards also we keep changing. Auditing standards also we keep changing. So people have arguments, but who is the real king of changes? SFM. Why? Every day, any small news, there is some Omicron virus breakout, stock market falls. You have to be on the toes every second. So, managing a fund, investing in stock market, and continuously assessing is not an easy job. We need somebody to do it for us. You have certain, I mean, you have measures like that also. We have called as PMS, portfolio management scheme or portfolio management companies. But portfolio management service companies. PMS, you cannot be a retail investor. You have to be a HNI, high net worth individual, like having investment of 50 lakhs at least. Because you are appointing a person to manage your fund is like a personal fund manager for you. So you need to have a very good investment, very good fund, very good corpus. And he's going to charge you a bomb as well because he's a fund manager. No, he's an expert. After becoming a CA, will you do the things for free? No, you have sacrificed so much. I need not tell you what are your cost of sacrifices. You need compensation for that now. You will charge. Similarly, the professional will charge a bomb. So if you are an individual investor having 10,000, 15,000, 20,000 per month, or let's say even 1 lakh per annum, that is not really worth going to a PMS or not really worth hiring a personal financial consultant. So what you do? People like this, many people come together and appoint one person. And let's say 1 lakh, one person, 100 people come together. That becomes 1 crore. Now, 1 crore can be managed by one person. 100 people have invested. Now, that one person you have to pay him salary. Yes, he will charge a good amount. He's an expert, he's a professional. But that expense will be distributed among so many people, so that expense will not hurt you. There are so many other things you have to take care, okay? You have to maintain, you have to keep track of bonus shares. If any right shares comes, you have to subscribe to it. There might be stock split, there might be merger news. So investing in individual thing may not be very uh, smooth. Now, if you understand in another way, suppose once you start earning, suppose I say, can you give me the money? I will manage your money. I know people are telling no. First of all, we are taking we are paid for your classes and we are listening to your words. That itself is a great thing. We should give money to you. No way. I understand your feeling. At least for example purpose, you could say yes. Anyway. So, if you people come together, appoint a person and who will manage the money on behalf of you, that structure is mutual funds. So essentially, mutual fund is a more of a trust. It's not really a company. So many people pool the money together and forming a trust, forming a fund for the purpose of meeting the objective of the investors. In fact, you have to understand mutual fund is more like a product. Like one company can have many products. So we have mutual funds, many products. We have to understand how many types of mutual funds are available, what type of mutual fund requires suits your requirement. All those things we have to understand. So overall, how the mutual fund structure works, let me tell you. So if you take the mutual fund as the intermediary, you will have various money coming in, money coming from various investors. Mutual fund holder is what we call them. So various investor come and invest money. That is what is called as pool of money. And mutual fund invest in stock market. Essentially, we have other types also, but let's say essentially they invest in stock market. So we have various kinds of investors or mutual fund holders, and mutual fund will invest in stock market. And you cannot invest in one stock. You have to invest in a portfolio of stock. Now, how to build a portfolio? What are the principles of portfolio? An individual may not be able to know it. That is what is managed by a fund manager or called as AMCs. This mutual fund is managed by fund manager FM or also called as AMCs, asset management companies, AMCs, fund manager. And whatever the returns you get from the stock market in the form of capital gain, in the form of dividends, will be distributed among investors or it will be reinvested. We have those type of methods. There also some calculation should be done, some expense should be considered. All those things we will see it. So essentially, if I compare, one more thing will be there. This mutual fund, who will float? For companies, there will be promoters. Then they will issue the units to the public. So like mutual funds also, somebody should float it, somebody should start it. They are called as sponsors. They are called as sponsors. So I'll do one thing. Quickly I will compare the comparison between a company and a mutual fund. Okay, this is only at a conceptual level, not at a legal level. Company and mutual fund. Okay, company will have shareholders. Company will have shareholders. Mutual fund, we don't have shareholders because they are not really shares. We call them as investor. No, they are called as unit holders. Unit holders. And company managed by board of directors, and mutual fund we have managed by board of trustees. It's basically a trust. So board of trustees. So company will have like articles of association, memorandum of association, the guidelines for them to run. Mutual fund will have board of trustees, so they will have trust deed among the board of trustees. And companies primarily floated by promoters who begin the company, and in mutual fund we call them as sponsors. Sponsors. A company managed by managing director, a head you can say. Mutual fund managed by fund manager. A quick comparison. So companies are primarily governed by Companies Act. Primarily governed by Companies Act. And mutual fund primarily governed by SEBI. I mean, companies also will have SEBI listed company. Mutual fund, whether in company form, Companies Act also apply. But primary application is what I'm telling you. Companies are primarily governed by Companies Act. Mutual fund are primarily governed by SEBI. I hope you have taken down this basic structure of mutual fund. Basic structure. And essentially, mutual fund is where the retail investor come in, the public come in. So the SEBI has to be very vigilant, very careful, because what is the purpose of SEBI? To protect the interest of investors. And so many retail investor, public investors are here. So SEBI is very, very careful and very strict in framing the guidelines, the rules applicable to mutual funds. And various other forms also are there. Mutual fund, venture capitals fund, private equity fund, then we have a hedge fund. All those things will come to it later. But let's understand the basic structure of mutual fund. Public is involved, so SEBI will be very careful. Okay, let's look at some advantages of mutual fund. One more small point I would like to tell here itself. So essentially what I told you, various investors coming, instead of they going to stock market directly, that will be a risky job because you need to manage portfolio, you need to do continuous assessment, you need to track news, you have to select proper companies, you have to understand financials, you have to interpret, you have to track, continuously assess, monitor, and any changes you have to do. So all those things requires a lot of time involved and professional element involved, for which all investors come together, make a pool of fund. That's what mutual fund. They invest in stock market. Now, when they invest in stock market, why don't we expand to other asset allocations? Yes, we have mutual fund who invest into money market, debt market, government bonds, RBI, government bonds, treasury bills, liquid funds. We have lot of debt funds. We have combination of both. Call them as arbitrage funds. I'm going to come to it in some time. And they can also invest in real estate. We have real estate mutual funds. See, if you want to own a property and get a rental income from that, it's not easy because property will cost you crores and hundreds of crores maybe. But if 100 people come together, 1,000 people come together, you can share proportionately, right? Yes, that's what advantage of mutual fund. We have real estate mutual fund. You give the money to mutual fund. They will buy the properties. They get the rental income and share among all of you, the unit holders. That's one more thing you should understand. The difference between company and mutual funds. Company cannot have fractional shares, but mutual funds can have fractional units. You can get 10.5 units, 10.25 units. Fractional units are allowed because primary purpose of mutual fund is not to get money. The primary purpose of mutual fund is to give a investment opportunity for the investor, for the unit holders. He says, I want to invest 10,000. Yes, enter 10,000, you should take it. Not saying our share price is so much, please round up and give it to us. So fractional units are allowed in mutual funds and managed by fund manager, asset management companies. Okay, so having look at this, let us understand some advantages of mutual fund and disadvantages or limitations. You can say disadvantages or limitations of mutual funds. Please, you also write it down parallelly. Advantages. First thing, professional management. I just told you now. In spite of you being an expert, in spite of you learn the SFM such a long time, if you don't practice in this area, you will not be able to make a successful investment. Because I told you, SFM is the most dynamic subject you can have. This is like walking on a treadmill. If you keep walking, you will stay where you are. If you stop walking, you will fall or you will fall behind. Like a walking on a treadmill, you have to be continuously running. That is this subject. Every day it changes. Every minute, any news comes, we have to understand which stock gets affected, when to buy, when to sell. There is one Omicron virus, suddenly you have to sell aviation stocks. Because you know, if lockdown happens, aviation stocks, Indigo, SpiceJet is going to fall. And stocks like Indian hotels, Taj VK, hospitality business, PVR Inox, entertainment business is definitely going to be affected. Sell those stocks immediately and buy the stocks, pharma stocks who supply oxygen to hospitals, because that is what is mostly required during the corona if there is a hospitalization. So start buying those stocks. IT stocks you can buy more. Even if there is a lockdown, IT stocks will be functioning. So their profit or loss will more or less will be maintained. So IT stocks you can enter. You can buy consumer goods, because if you're locked down, consumer goods will definitely be used. So their sales will not be affected much. In fact, maybe consumed more. Maggie may be consumed more because some hotels you may not go there. Zomato you can buy because their sales will increase, because the people who order home will get more, will increase, right? You have to catch the opportunities. As a mutual fund manager, those people do it. As individual people, you will not have time because you have to do your job also. And even if you, others don't have expertise only. So expertise, time, patience, skill, you need to continuously update yourself. New elements will come. Should you invest in cryptocurrency? Should you invest in robotic companies? So understanding about the companies requires time. Analyzing financial statements. So many things. Professional, we believe, are able to do it. And the beautiful diversification. Don't put all the eggs in same basket. Don't keep all the money in same pocket. Your friend might take you all. So you have to invest in a diversified stock, different sector, different nature. You have to invest in large cap company also, small cap company also, very established company also, new age company also. You have to have a proper mix. Mutual fund or portfolio management is not a individual player game. It's a team game. It's a cricket. It's football. You need all the varieties of players. You need all the varieties of performers. That is what is equity shares. You need a risky stock like Sehwag. You need a defensive stock like Rahul Dravid. Both are required to maintain the balance of a team and of a portfolio. Diversification. That is done in mutual fund. Essentially, mutual fund is a portfolio. So when you buy shares of a company, you buy only that share of a company. But when you buy mutual fund, essentially you are buying their portfolio. Convenient administration. So if you have to do it yourself, where the shares comes, dividend comes, bonus share comes, right share subscription, bonus shares comes, stock split happens, merger happens, read annual report, see if any management changes happen, continuous administration. You don't have to do mutual fund. You open a demat account, mutual fund will be there, or you don't require demat account also. Directly you can invest through some brokers or some distribution agents. You can have the mutual funds account directly. Low cost management, that is because many people come together. The cost of the management, we call it as expense ratio, will be distributed among various investors. Therefore, it is low cost management. Liquidity, you can sell anytime. You invest in real estate, can you sell anytime? You start a business, you are a partner, can you exit from your share easily? No, it takes a lot of time. Invest in mutual funds, at any time you can easily exit. You'll always have other, you can always redeem it. You can buy anytime, you can redeem anytime. You will have a cut-off time. That is, mutual fund cannot be invested throughout the day like shares. You can invest only at the end of the day. Will be cut-off time like 2:30, 2:10, like that, 1:30. Only after that, whatever NAV at that point in time, you can buy so many units. I will discuss more when we discuss about the NAV part. Highly regulated, as I told you, public money involved, retail money involved, government will be very careful. So SEBI will is formed primarily to take the interest of investors. So there will be a lot of regulations. For example, how much expense ratio you can charge. You cannot charge more than 1%. Disclosure requirements. When you initially scheme document, offer document, so that investors are fully aware of the terms and conditions for investment in mutual funds. Of course, people don't read, that's a different issue, but they make so many formats, regulations. What are the guidelines for valuing assets for the purpose of NAV, net asset value per unit? How much expense ratio they can limit? Which portfolio they can have? They have certain conditions. What name you can give for mutual fund? What is the frequency of NAV? Lot of points, highly regulated by SEBI. Limitations or mutual fund. No guarantee of return. I think you must be aware of it. What is the first thing come to your mind when somebody say mutual fund? Mutual fund are subject to market risk. Please read the offer document carefully before investing. Right? Basically means mutual fund is relatively less risky because a professional is managing it. Does not mean it will guarantee you a return. Mutual fund will not guarantee return. After all, it is investment in stock market. If stock market falls, the mutual fund value also will fall. But only thing is, the probability of falling rather than you doing it compared with mutual funds is less. That is, you do it yourself, it is unprofessional, the chance of more. It's like asking, should I go for classes or should I do self study? Self study also you can do, but you need lot of time. You can go to class, the faculty will do lot of things for you, does not guarantee your results. Still you have to do your job, still you can fail, right? But by coming to classes, the probability of failure may come down. Same way, when you invest in stock market, the probability of failure, the probability of loss may be more. When you invest through mutual fund, because he's a professional, the probability might be less, but probability still there. When the market falls, you still have a loss in mutual funds. Mutual fund does not guarantee return. It's relatively less risky, does not mean it is risk free. And ultimately, you have to select a person, right? What is mutual fund? I just told you, it is giving all the money to one person, one mutual fund, and they manage, they buy, they sell, they time the market, they select the sectors, they select the companies, they do the evaluation. So it's all built around the fund manager, built around the fund. If what if there is a scam in that fund, or what if they are not efficient, that left to you. Ultimately, which fund you pick. It is like a person appointing in your person appointing for your job. So a person is doing that on behalf of you, but whether he is efficient or not, whether fund is properly managed or not, that's always depends on your selection. Ultimately, if you select a good fund, you make good money. You don't select a good fund, more or less, you will lose money. So ultimately, like appointing an employee, choosing a fund is also left to your discretion, and you make a better choice of fund, you will make more money. So fund selection also plays an important criteria in performance or success in mutual funds. Cost factors, there is decent cost being there. Some, I know SEBI will restrict the maximum percentage. Earlier it used to be very high, but even then, some people charge 1%, 1.5%, 2% of fund management as a expense ratio, which might be costly because let's say 1.5% per annum. It looks small, but over a period of years, compounding effect that might be big as compared to an index fund or an ETF where the cost of management is very less. What is ETF? We'll come to it in some time. Sometimes transfer difficulties may come. You may want to switch between mutual fund to mutual fund. You may want to sell this and buy new things. Some transfer difficulties may be there, negligible, but still can be there. And one more biggest advantage I forgot, that is tax saving, right? Tax saving. That is ELSS scheme, equity linked saving scheme. Section 80C, investment up to 1,50,000. We have various alternatives, LIC, PF, housing loan, right? FD, 5 years. But the lowest lock-in period you have is mutual funds. Now, mutual funds has 3 years lock-in period. ELS schemes, you can save tax. And not only that, during those 3 years, stock market grows, your investment also grows. So according to me, the best investment plan you can have is in ELSS. And also I'll get to give you one small tax planning advice. Secret. I follow it. What is the time? The time limitation? Lock-in period? 3 years. So what you do? You invest in first year, whatever the amount. You invest in second year. You invest in third year. Okay. Now over a period of 3 years, money would have grown for sure. And that too, it might grow you, like in last 1 year only, it actually index doubled, more than doubled. But anyway, uh, Assume that it will not grow much, more or less remaining same. Even then, what you can do, what you invested in year one, you can exit in year four, right? Because 3 years over. Now what you do, sell that amount, sell that mutual funds, you get money, reinvest in the fourth year. You don't require additional amount of income, additional amount of investment. First year amount only, you reinvest in the fourth year. Second year amount, you reinvest in the fifth year. Third year amount, you reinvest in the sixth year. Then, seven, you reinvest the fourth year. It's a cycle. So, if you are planning for investment, one secret I'm telling you, invest only for first 3 years. For rest of your life, it is taken care. Your investment will grow also, and next subsequent year, you don't have to worry about Section 80C additional investment. The first 3 years will keep on rolling. You keep selling and buying, the investment in 80C will be taken care. Anyway, that's a taxation aspect for you. Let's just focus on the mutual funds. And mutual funds, like for example, are highly regulated. I also should have talked about this point. Now, I have given the money to mutual fund. It's managed by fund manager. Can they invest wherever they want, or do they have some restrictions? Do they have some limitations? Yes, they have limitations. So, can we know where they invest? Yes, they have to disclose their portfolios. Let me show you some practical stuff as well so that you will get a practical idea. So you can go to various mutual funds. Let's say I'll go to Value Research Online. We have Money Control. We have Morningstar. Value Research Online, I think, is considered one of the good thing for mutual funds research. Hope it's visible. So if you select, let's say, HDFC Flexi Cap Fund. So what is this Flexi Cap, Large Cap? I'll come to it. Just understand HDFC Flexi Cap Fund. We have direct plan, indirect plan. I'll explain you what is that. Suitability. They will have investment strategy. See, they should give you. Every mutual fund should give their strategy. They cannot invest wherever they want. And some details. You see, minimum investment 5,000. Minimum additional investment. SIP investment, systematic investment plan. Minimum withdrawal. And HDFC Flexi Cap, how it perform versus BSE 500. That is their benchmark over a period of time. Year to date, how much return they have given. One day, 1 week, 1 month, how much return it is provided. Year to date, this has provided 34%. Whereas funds in this category, average they have given 30%. So this fund is performing well than average returns. 1 year return, 3 year return with performance with peers. Okay. Risk measures. We calculated so many statistical measures. Mean, average return, standard deviation, Sharpe ratio, Sortino ratio. Sortino ratio may not have learnt it. I'll tell it later. Beta, alpha. I'm sure you might remember all these terminologies. Asset allocation. Yeah, this is what I just want you to tell. Where they have invested. HDFC Flexi Cap Fund. In SBI, they have invested 9.45% of the assets. ICICI Bank, they invested 8.22. They invested in NTPC, Larsen Turbo, Infosys, Coal India, HDFC Bank, Reliance Industries, Power Finance. They have to disclose their full portfolio. Let me take a look at one more Flexi Cap Fund. Let's take a look at ICICI Prudential Flexi Cap Fund. Let's see where they've invested quickly. These people have invested in ICICI Bank, HDFC Bank, Mahindra Mahindra, Bharti Airtel, Reliance Industry, HCL Technology, SBI Life Insurance, Infosys, State Bank of India, and oil, natural gas, and so many. We can look at few more points. I would like to. Who's AMC? Remember AMC? Who manages this fund? AMC, ICICI Fund Management, the ICICI Prudential Asset Management Company. Their address is there. A few more details I would like to show it to you. When is it started? Launch date. Fund house. Okay, ICICI Mutual Fund House. There should be fund manager also somewhere. Assets under management. How much fund they are managing? 11,493 crores. It's not small number. 11,493 crores. The highest mutual fund is actually Kotak Flexi Cap Fund. That is the highest mutual fund as far as my memory is concerned. Let us look at their fund management. Just 1 second. Okay. What about their details? How much fund they are managing? Take a look at this 38,521 crores. That is the amount of investment management, AUM, asset under management, total fund managed by this fund. According to my memory, this is the largest mutual funds. 38,500 they manage. Expense ratio, what they charge. Launch date, they started in 2013. I think they should have fund managers. Fund manager, they have it here. Fund manager, who is the person managing it? Harsh Upadhyaya. Is a B mechanical from NIT Surathkal, PGDM from NIM Lucknow, CFA from CFA Institute USA, experience, funds managed changed, where he was there previously, you see, complete data will be there. This much transparency is required. They are all SEBI guidelines. Portfolio, you have to make it public. You have to disclose the data like who is the fund manager, what is the background, when the fund was launched, what is the performance of the fund as compared with its benchmark, what is the category. We also have something like a riskometer. We have riskometer very high, so the investors will be aware what nature of this investment, because equity are all coming under very high. We have debt mutual fund, we have government bonds, they will be high, moderate, low, something like that. Liquid funds low, like that. We'll come to it. In one way, you can, if you want to choose a company, no, how to invest, in which company to invest. If you want, you can use this as a shortcut. Okay, that is my recommendation, my suggestion. Don't take it as a recommendation. It's my just one of the plan, you can say. You look at many mutual funds where mutual funds mostly invest in those stocks you go and invest, and you want to find out some new company, multi-bagger. Look at this where you have not heard of any company names. Maybe you've not heard of EU Small Finance Bank. Maybe you've not heard of SRF. So, whichever company you have not heard of, maybe you can spend more time. They can be good returns. Or these new names where many mutual fund invest, those stocks you can invest. Easy picks, right? You don't have to do the efforts. They would have done the research. That's what they're paid for. They would have invested. You just pick it. Nowadays, there's also one product given by Small Case, that is by Zerodha. So there's one thing called a small case. Many people confuse a small case with mutual funds. So what small case does is, if you have a theme, I want to invest in electronic vehicle theme, I want to invest in a weatherproof theme. So if you are following a theme, they will suggest you companies and how much to invest. That's what they call a small case. It's not managed by anybody. It's you're only investing. They are recommending which stock to invest in what proportion following a particular theme. That is not managed by SEBI and all. They are just consultants. Keep that in mind. Mutual funds are SEBI managed. They are professionally managed. Okay, so if you have any questions on practical aspects, you can ask. Otherwise, I'll go to the next segment, which is classification of mutual funds. Okay, I believe no questions, so I'll go further. Okay, so back to the PPT. Classification of mutual funds. What are the types of mutual funds we have? Okay, types of mutual funds. Classification of mutual funds. We can do it based on various ways, like function based, objective based, and so on. I think one more also I should add. Let me talk about that first, then I'll come to this. Based on type of investments, we have direct mutual fund, indirect mutual fund. This type of question have not asked me in the exam. Mutual fund is one area, from exam point of view I'm telling. Mutual fund is one area, is very simple in the class. Problems are very simple, but somehow in the examination they will make it complicated, because what we do in class, we will give you NAV, we'll ask you to compute returns, but in exam they will give you returns, ask you to compute NAV. So this reverse calculation problem and all very popular in mutual funds. And every time I've seen some new theory question comes in mutual funds. Especially in this chapter, I'm telling you, especially in mutual fund chapter, they keep on asking new varieties of theory question as well as practical questions. So wherever possible, if new terms comes in this chapter, pay attention. So one of them is this direct mutual fund, indirect mutual fund, that have been not asked in examination so far, but in real life it is very important. Many people don't know this difference. You can educate your clients, you can educate your relatives, friends who are not into finance background, but they have to invest as well. I'm sure you would have watched the advertisement, mutual fund sahi hai. Yes, you would have watched it, but you never see the difference between direct mutual fund and indirect mutual fund. That is important. So what is direct mutual fund? It is like investing through demat account. Direct mutual fund is requires demat account. Indirect mutual fund is a folio method. It will have a folio allotted to you. A portfolio management, one folio is given to you, divided to you. It's a folio method, folio management. You don't require demat account. So basically, indirect mutual funds, I mean, what is direct mutual funds? I'll just show it to you. You have investors, you have mutual funds. You directly give the money to mutual fund through demat account. That is direct mutual fund, direct MF. Whereas investors, go through some agents. They're called as mutual fund distributors, MF distributors, MF distributors, and they invest in mutual fund. This is called as indirect mutual fund. Now, these mutual fund distributors will not charge money from you. These mutual funds, they will pay commission. Like insurance agents, when you buy an insurance policy, you don't pay anything to the insurance agent, but the company will pay. They are like salesmen to them, right? So company will pay the commission. We have various aggregators in the internet. You can search for it. Various people do this. We have Zerodha, who have something called as coin, but they don't charge any commission, because when you invest in coin means that's a product name. You select the mutual fund direct only. Even though mutual fund distributors are not charging anything directly to you, but who will pay them? Mutual fund. And for mutual fund, where do you get the money? From investors only, right? So ultimately, from your pocket only it goes. You don't realize it. So if you are investing, please invest in direct mutual fund. It's been introduced about 3-4 years back, not many years back. Earlier, you did not have this option of direct indirect. Now people have. So please make sure that you invest through direct mutual funds. You should have a demat account. That's all the requirement. Indirect mutual funds also, you should do the same exercise. Which fund to invest? Same thing, instead of investing in direct mutual fund, indirect, you just select the direct form, just a form. Then why indirect still exists? Just because people are not aware of it. Over a period of time, indirect mutual fund will definitely be minimized to great extent as and when people are aware that something called as direct mutual fund. Anyway, I hope you understood the difference between the direct mutual fund and indirect mutual fund, where you have demat method, you have portfolio management, a typical question you can expect, new question you can expect in exam. Differentiate direct mutual fund, indirect mutual fund. If you're able to use the word mutual fund distributors, you'll get the full marks. Even when I showed you that HDFC Flexi Cap, ICICI Flexi Cap, Kotak Flexi Cap, they always chose direct, indirect. I'm not sure whether you observed it. If not, please go to the website and check it out. They will have to give you two sets of details for direct, for indirect. Portfolio will be same, manager will be same, expense structure will be different, and hence NAV will be different. Okay. Okay. So I hope you have taken it down. Let's go further. Function based classification. We have open ended mutual fund, close ended mutual fund. We also have interval funds. It's a very important point you have to understand. And 99% of the mutual funds are open ended. So when we say mutual funds, mostly we talk about open ended. So let me talk about open ended. What do you mean by this? In companies, let's say you want to buy the shares of Infosys. You want to buy the shares of Infosys. From whom will you buy? Will you buy from Infosys, or will you buy from another shareholder? You buy from another shareholder, right? Not from Infosys. You buy from Infosys in one case, that is in IPO or FPO, initial public offer or further offers or subsequent ones. right? Their company will issue to you directly, but in all other cases, it through secondary market. But in open-ended funds, if you want to buy the units, you will buy from mutual funds. So investor and mutual funds. So when investor wants to invest, he gives the money, invest in mutual fund, and what mutual fund does, they will issue units. They will not give you shares, they will give you units. And when investor wants the money back, he will not sell it to somebody else. He will come to mutual fund only. Investor come to mutual fund and they say, I want money. So investor will take the money, that is, will redeem the units. Investor will get money back. So whatever money back, investment gets back. See, they get the money back, investment back. And what this process is called as redemption. Units will be redeemed, units will be given back. Units are given back, units are back, and that's called as redemption of units. Redemption of units. So this is what is purchase. And this is what for you it is sale. So difference is for you capital gain. But from mutual fund point of view, the terms used are at the time of investment, they call issue of units, and at the time of repayment, that is redemption of units. Instead of money back, you can say repayment or withdrawal, whatever it is, withdrawal, redemption of units. So if you want to invest, you go to mutual fund directly. When you want the money back, when you want the redemption, you go to mutual fund. You don't go to somebody outsiders. Like if you want to buy the shares of Nestle, you'll buy the shares from another shareholders. Like you go to Demat account and you buy. Other person is selling, other person. Meaning you are buying from another existing shareholder. It's a secondary market. Whereas mutual fund is not directly through a secondary person, it is directly through mutual funds. You are buying from mutual fund, you are redeeming with mutual fund. It's a direct contact between you and mutual funds. And therefore, mutual funds are not traded in the markets. Open-ended funds are not traded in the market. Not traded. They will not have price. They will have only NAVs. What is NAV? I'll come to it in some time. And in this process, you can also invest fractional units, right? I told you, you can invest 1 lakh. They will compute NAV, 1 lakh by NAV, how many ever number of units, they are forced to give it to you. Fractional units are possible. Open-ended funds, why it's called as open-ended? It's open anytime. You go to mutual funds, open anytime, you place an order, it will get executed. Now, in stock market, because secondary market, you will have price at 9:15 market opens. You can buy at 9:20, you can buy at 9:37, you can buy at 9:52, anytime you can buy. But mutual funds will have a cutoff time. Throughout the day, you cannot buy mutual funds. Even if you place an order, it will get executed only after cutoff time at 1:30 or something. They will have a cutoff time. At that point only, whatever is the NAV, your fund will get invested. So you get units only next day or a day later. They are not traded. Whereas close-ended funds, they are traded. They will have price. Close-ended funds. Why it is called as close-ended? Just like the shares. Initially, company issue the shares, you get allotment, IPO allotment. But later, if you want the shares, the company will not give it to you. You have to buy from another shareholder. Exactly the same way. Closed-ended funds, initially mutual funds will give it to the person. But later, if you want that, company will mutual funds will not give it to you. You have to buy from the existing unit holder. Closed-ended funds are traded. They will have price, but their ratio, I told you about 1%, hardly negligible. We have interval funds, combination of both. It's open for some time. where you can buy and sell from the mutual fund. Later, it becomes close-ended. It's even more negligible. Only few funds are there, which we did not worry about. Okay. Then investment-based, portfolio-based, equity funds, where they will invest only in equities. And that too, which type of equity? For example, they have large cap. Now earlier, some different name used to be there. Emerging, blue chip fund, something like that. The mutual funds used to name like the way they used to name their children's. Different mutual funds name used to come, and there was no standardization. SEBI 3-4 years back has standardized the names. You have to give a name clearly, like ICICI blue chip or ICICI large cap, Kotak large cap, SBI large cap. So when you say large cap, you have to invest in large cap. Cap means capitalization. Large cap companies, high value companies. In when they give you offer scheme, I showed you in the website also. Objective, they have to specify. They invest in large cap. Like they have restriction like 65% should be invested in large cap. Say definitions are there. Let's not worry about the definition. They should invest primarily in large cap companies. What is large cap? Any idea? What is large cap? What is mid cap? What is small cap? If company has the market cap of 1 lakh crore, is it large cap? Not that way. SEBI has come up with a guideline for that definition also. Who are large caps? We have one website, AMFI, Association of Mutual Fund Industry in India, AMFI. In the AMFI, every 6 months, they will announce which are large cap companies. They take the top capitalization from BSE, they take top capitalization from NSE, they mix it, they take an average basically, and 1 to 100, company 1 to company 100, top 100 is defined as large cap. So large cap equity funds should invest in those 100 companies. Weights you can change, but the companies are restricted to 100. Then 101 to 250, in the sense next 150 companies, they are called as mid cap. Top 100 is called as large cap. Next 150 is called as mid cap. So every 6 months once, the definitions will be given by the AMFI website. So the fund manager has to make sure he invests only in those top 100. If some company goes out of 100, he should exit those companies. Some allowance is there, but primarily you have to invest in those 100 companies. You are a large cap. You are a mid cap, next 150 companies. You are a small cap, any companies below that. If you tell you are a small cap mutual fund, you cannot invest in large cap. Some levy is there, but primarily you have to invest only small cap companies. Most famous is a small SBI small cap. Let's do one thing. Let's quickly look at that to you. SBI small cap. Or I'll just put the large cap first. You have HDFC, liquid funds. Okay, Kotak. Nippon India large. Nippon India large cap fund. It's a large cap fund. So they should invest only in large companies, large cap companies. Let's look at their portfolio. HDFC Bank, SBI, ICICI Bank, Bharti Airtel, all the names you know, they are large cap companies. Let's look at some mid cap companies. Let's say I look at HDFC mid cap opportunities, HDFC mid cap fund. Let's look at their portfolio. See, they have invested in Cholamandalam, Balkrishna, Bharat Electronics, Aarti Industries, Sundaram Fasteners, Max Financial. Some of them you heard it, somewhere you heard it. Essentially mid-cap companies. Ipca Laboratories, Persistent System, Apollo Tires, Atul Limited, Supreme Industries. They're all mid-cap industries. Then I'll show you small cap, SBI small cap fund, considered to be a decent fund. What their portfolio, where they have invested. Coromandel Universal, Sheila Foam, Blue Star, Hudson Agro, Finolex, JK Cement, V-Guard, LG Equipments, V-Mart, Triveni Turbine, Rosary Biotech. You've not heard of it, right? They're small caps. Lemon Tree Hotels, Novin Fluorine, Kalpataru Power Transportation, Fine Organic, DTK Prestige. They're all very small companies. Do you understand? According to the nature, you have to give the name. You should have an investment objective. Let me read what is the investment objective. Let's read. Not sure it's visible. The scheme seeks to provide the investors with the opportunity for long-term growth in capital along with liquidity of an open-end scheme by investing in predominantly diversified package of equity stocks of, look at it, small cap companies. Their objective itself is to invest in small cap companies. Name also is very clear. Small cap fund. Earlier they used to give some emerging opportunities, jewels fund, they used to give something like that, but now their name is more standardized. Okay. We also have then multi-cap fund. See, I don't want to invest only in large cap, in mid cap or small cap. I want to have freedom. I want to invest across multi-cap. Multi-cap means I should invest in large cap. I should invest in mid cap. I should invest in small cap. I should invest. I must. That is multi-cap. Then we have a flexi cap. Flexi cap means I can choose in some, the fund manager has the flexibility. So I like flexi cap more because multi cap will force you to be invested in these type of companies. Whereas flexi cap means manager can choose. Now market is falling. I will invest only in large cap. After some time, oh, we are in bull market now. We will invest in small cap. So that flexibility will be there. The discretion is available in case of flexi cap. We also have other type like dividend yield funds, multi-cap funds I told you. We have value fund, contra fund, various types are there. But please try to remember these funds at least: large cap, mid cap, small cap, multi-cap, flexi cap. So these are into equity funds, and when you design the scheme, the objective must mention what is your target, and later you cannot change it. So once you say it's a large cap fund, it should always be invested in large cap fund. You can't come to mid cap fund. And SEBI has also put one more restriction now. One mutual fund house, one AMC can have only one in the category. For example, SBI small cap. They cannot have SBI small cap 2. In one category, one mutual fund can have only one fund. You cannot have more than one. One category, one fund for every mutual fund. Restrictions. We have debt funds. Debt funds means who invest in debt instruments. We have liquid funds. Let me go through it quickly. What are those liquid funds? Because a little bit of duration, a little bit of your bond valuation concepts can be revised for that manner. Let's see if I can show it to you. Okay, I'll just show. Let's say uh, HDFC liquid fund. They are debt instruments. Why debt instrument? They don't invest in equity. They invest only in debt instruments. Which type of instruments? I think definition is not given here directly. Okay, just take a look at this one. Portfolio aggregates. Modified duration. Do you remember, my dear friends? Duration, modified duration. Duration is a Macaulay duration. Modified duration, volatility. Remember, see, look at this duration 0.08 means less than 1 year, 0.08 year, very, very short. Liquid fund should invest in instruments having maturity less than 90 days, having duration less than 90. Let me just quickly do a search for you. Uh, SEBI definition of debt funds. I mean, you don't have to remember. I mean, exam they can ask you, but still. Okay, let's look at this. Is the official website, AMFI India, Association of Mutual Fund in India. I hope it is in readable condition. Just zoom it a little bit. Okay, overnight fund, overnight securities having maturity of 1 day only. Liquid fund, you see, debt money market securities with maturity up to 91 days. Liquid fund should invest in an instrument having maturity only 91 days. So they are having less risk, so less return. We have ultra short duration having Macaulay duration between 3 months to 6 months. Macaulay duration, duration in bonds, remember? Bonds duration, how do we calculate? One column year, one column cash flow, coupon along with redemption price, next column discounting factor at YTM, then we calculate discounted cash flow. Discount cash flow is a weight, year is x xw product divided by market price, sum of weights. Remember, duration. Yes, when ultra short mutual fund invest in bonds, how do you pick those bonds? What condition of those bonds must be there? You have to invest in a bond having Macaulay duration between 3 months to 6 months. The duration, Macaulay duration means duration between 3 months to 6 months. So they have to calculate the bonds, and whichever fall into their category, you have to choose. Of course, if it satisfies the risk criteria as well. Similarly, we have other varieties, low duration, Macaulay duration between 6 to 12 months. Money market fund, short duration fund, long duration fund, more than 6 years, less 7 years. Higher duration means, higher volatility, higher risk. We have credit risk fund, backing PSU fund, gilt fund, only invest in government securities, floater funds, dynamic fund, they can invest across duration, like flexi cap. In equity, we have dynamic bond. Some more terminologies I would like to show it to you. A kind of revision of your bond valuation chapter. You look at their portfolio. We are looking at the portfolio of liquid fund. See where they've invested treasury bills, commercial papers. Look at the ratings. Treasury bills, government, we say SOV, sovereign ratings. Commercial papers, A1 plus, sovereign, A1 plus, they're all short term. Short term will have the credit ratings, A1 plus, A1, that is ratings, short term rating. Let's look at long duration funds. Okay, let's look at HDFC corporate bond fund. So they invest in corporate bonds. Let us look at their portfolio. See what is their rating. You remember AAA rating, AA rating, credit rating. Yes, they have invested. And what is their duration? Modified duration 2.83 years. Long term one. It's more than 1 year. Long term one. Credit rating is AAA, sovereign. Okay, they are investing only in AAA bonds. AAA bonds, SDFC AAA bonds, Bajaj Finance, Perfin Corporation. So you can say AAA is likely to go, less chance of being bankrupt. But there are some situation happened. Okay, India Bulls Housing Finance. There are some dynamic bond funds which I had invested actually. Some of them had gone, some of the companies defaulted. Some of these companies issued bond defaulted. So mutual funds also defaulted to that extent. We call them as side pocketing. One term they ask in exam also, side pocketing. So in this context, I can explain you that side pocketing. What is side pocketing? How this debt mutual fund works? Okay, let me go back to the PPT and I'll explain you what is this side pocketing. Okay, how a debt fund works, how a fixed deposit works. Let me do a quick comparison. Fixed deposits versus debt funds. Okay, so you, a deposit holder, let's say individual investor, give money to bank. That is, you will have in the form of FDs, and bank will pay you interest. And where bank gets the money? They give loan, right? Various types of loans. They give businessman loan, personal loan, housing loan, various types. You will give it to various business, personal loan, housing loan, vehicle loan, etc. Various types of loan, various types of borrowers. I'll just say borrowers. And borrowers pay interest. Now, if borrowers don't pay interest, if there is a default, will you get the interest or not? What do you think? Will FD interest to be paid or not paid? Yes, it should be paid. So bank is assuming this loss. Bank is assuming this risk. Assuming is this risk. That's why you have low risk, in fact no risk. That's why FD rates will be very, very less. But there are cases where even interest did not pay. Forget about interest, your FD also money did not came in. Yes bank situation it happened. Yes bank. Right, when money shortage was there, liquidity shortage was there, you could not withdraw FD. Later RBI came and supported it. It's a different issue. That's why many people still refer traditional investment FD. Then what is this debt mutual fund? How does it cover? We have individual investor who invest in mutual fund, debt mutual fund, debt mutual fund. That's what they invest. Means they will buy units of debt mutual funds. Now, debt mutual funds will invest with whom? They will invest in corporate. For example, I showed you now corporate bonds. Like they'll give the money to corporates. Basically, they'll invest in corporate bonds. And they will pay the interest. Therefore, will you get the interest? No, you don't get regular interest. When you invest in debt mutual funds, you don't get regular interest. You buy now, you sell later. This interest what they received, it will be accumulated in NAV, net asset value per unit. So you buy it on NAV, you sell at NAV, that becomes your indirect profit, indirect interest. And one more advantage of debt mutual funds is if you hold more than 3 years, it's called as long term, as per income tax act, and you can get indexation benefit. FD, there is no indexation and all. If you invest in a debt mutual fund, if you hold it more than 3 years, you redeem after 3 years, it's called as long-term capital gain. And while calculating long-term capital gain from debt mutual funds, you will have indexation benefit. So tax efficient is debt mutual funds as compared to FD. Okay, but problem is, in case they default, in case the company defaults, what will happen? Your NAV value will fall down. What happened in India Bulls Housing Finance? One debt mutual fund had invested in bonds issued by India Bulls Housing Finance. Now, Indiabulls Housing Finance, Diwan Housing Finance defaulted. They did not make the payment on maturity date. Not only interest, principals also they did not pay. Now, principal they did not pay. So, what this debt mutual fund did, they divided into two parts. That is, the debt mutual fund will have an asset, right? I showed you portfolio. Their portfolio, they segregated. The one is their existing portfolio, other portfolio, existing portfolio, and they created one new mutual fund they called as segregated units, segregated mutual funds, and these are issued to the individuals. And what these segregate units represents, segregate units represent the bonds of Indiabulls Housing Finance. So basically, whenever, if any, the Indiabulls Housing Finance gives the money to mutual fund, debt mutual fund, they will give it as it is to individuals. They don't take anything in between. They collect, they give. If they don't repay, you don't pay them. The value held by the individual investor in segregate units becomes worthless. So basically, what did this mutual funds did? They divided their portfolio, existing portfolio, bad debts portfolio, you can say, NPA portfolio, you can say. And for this NPA portfolio, issued units to the investors, telling this is the portfolio represented by these units. If they pay you, these units will be redeemed. If they don't repay, your units will be worthless. Remaining units, others can invest. So when new investor comes in, right, in open-ended funds, new investor comes in. So they need not be worried about this portion. They can continuously invest in the existing portfolio apart from these default bonds. They need not worry about this. They will not have the rights. They will not have the problems. They will have the new portfolio going on a continuous basis. So the new investor will not be bothered about the baggage. This process is called as side pocketing. Don't write in English literal. Side pocketing. Fund manager pocketing some funds. Your politician's mindset. No, that's not side pocketing. Side pocketing means when there is a default by investment by debt mutual funds, what they do, they will segregate the portfolio. One portfolio containing those default bonds, other portfolio containing remaining units, remaining bonds, and those segregated portfolio units will be issued to the existing holders. So, as and when money is recovered from that default bonds, money will be paid as redemption to the investors. And this will not affect the new investor for issue or for redemption purpose. So, these NPA basically, these bad debts basically kept aside. So, this process of keeping aside these bad debts aside, that is called as side pocketing. Hope you got a picture overview of what is this side pocketing means. Okay, so I'll take this part out. Hope you have taken it down. Okay, so we're talking about types of mutual funds. Now, again, here this also you should remember. Then we have balance funds. Balance funds who are investing in equity fund as well as debt funds. We have arbitrage funds, retirement funds, balance funds. We have aggressive balance funds, defensive balance funds who invest in equity as well as debt. And also understand these are all multiple funds. Okay, in the sense what, in large cap you will have open ended, close ended, interval, and in that you will have direct, indirect. Okay, these are all multiple folds. Hope you understand. And there also we have dividend funds, growth funds, bonus funds. Dividend funds means they will distribute regular dividends. Growth funds means they will reinvest it. They will not give you any dividend. These are all subdivisions. There are different features. So you will have different number of mutual funds. In fact, it runs up to some thousands of mutual funds. Broadly, we have only some 100 mutual funds, 200 mutual funds because it's subdivision. No, direct, indirect, open-ended, close-ended, and then with dividend growth. So this subdivision will make almost more than 1,000 to 2,000 funds. Anyway, actually more actually. If you take FMP, fixed maturity plans, it might run up to 1 lakh units also, 1 lakh mutual funds also. Okay, then we have certain objective based mutual funds, index funds. They invest primarily only index. For example, we have Nifty index funds, UTI Nifty index funds. They invest only Nifty 50. Their objective is to replicate only Nifty returns. They are not trying to outperform the market. They want to replicate the Nifty returns for you. So you cannot buy Nifty, you cannot buy benchmark index. They are notional portfolio. What you can do, you can buy its replica. Where is the replica? Index funds. What is the advantage of a large cap versus index funds? Large cap funds are managed by fund manager. They will have a high expense ratio. Whereas index funds, not really managed by fund manager. Fund managers don't have any job. He has to just invest in, he has to replicate Nifty portfolio. So expense ratio will be very less. International funds are also there. We have global funds. We have Motilal Oswal Nasdaq 100 funds, where they invest in foreign securities. They invest in US securities. See, in India, it's not easy to invest in Facebook, Netflix. Now the new things are coming in. New platforms are coming in, but still, I don't recommend you to invest in US stocks directly. If you want, you can use international funds so that you have a international exposure as well. Sector funds, we have Tiger Fund. There's one mutual fund called as Tiger. Tiger means T for traveling, G for something like E for entertainment, R for something real estate. They invest in various sectors. We have pharma mutual fund, those who invest only in pharma companies. So sector specific funds are also there. Money market funds who invest only money market instruments. Tax saving scheme, ELSS, I already told you. Lock-in period will be there. A sponsorship base, I told you, like a company will have uh, a promoter, mutual funds should have a sponsor. So public sector like SBI or Canara Bank, those are public sector mutual funds sponsored by public sector banks, public sector entities. Private sector, HDFC, ICICI, Axis. Axis is, I think, public, but anyway, private sector, foreign mutual funds, like we have certain foreign, we have DSP, BlackRock. It's a foreign mutual funds sponsored by foreigners, like that. So we have various types are there. So broadly I've discussed. Remaining other things are there, like full list of classification I've not told you. Because mid cap, large cap, large and mid cap, small cap, diversified, value, contra, focused, sectoral, thematic, ELSS, then also multi cap, flexi cap, debt wave, overnight, liquid, ultra short, low duration, money market, short duration, medium to long duration, dynamic fund, corporate bond, credit risk, banking PSU, gilt fund with 10-year duration, and floater fund. So many varieties are there. You cannot read all, you cannot remember all. Broadly, this much of type of funds, if you remember, that would be sufficient. Okay, so this is regarding classification of funds. Okay, we have to understand about the evaluation part and all. I think that we will take it up after a break. So take a break of 10 minutes, then we'll go for further evaluation of mutual funds. Take a break of 10 minutes. Okay, so let's move on. So we understood about the classification of mutual funds. Now let's go for the most important aspects, that is evaluation of mutual funds. And most importantly, uh, we have to understand NAV, net asset value. Basic formula, I'm sure you must be aware of it being a CA students. It is given by market value of the mutual funds holdings, basically market value of all assets minus liabilities divided by the unit size. Let me give you the purpose of it, and then let us go for uh, the calculation part of it in detail. But essentially, how do we calculate? Market value of all the assets minus market value of all liabilities divided by number of units. Why is this required? You have investors. There is mutual fund. Investor will invest money. They will give money. Invest. And mutual funds has to give a compensation. I mean, when you invest, what is the proof? They will issue units. Issue units. Now, how many units will be issued? Depends on the value at the time of investment. For that only, this NAV is used, investment divided by NAV. This is the value of every unit at this point in time. So investment amount divided by NAV is the number of units that is going to be issued. And later, during redemption, the amount should be paid, right? That is, the units will come back to mutual fund, and mutual fund should redeem. How much amount to be paid? Amount will be amount of withdrawal, amount of redemption will be number of units into value at this point in time, that is NAV. So this is like every day amalgamation happens, every day distribution also happens. At the time of acquiring a shares, value of the company should be there, and when you do buyback or when you do withdrawal, also value of company should be there. Anyway, that parallel you keep it aside. The structure, hope you understood. When a new person comes to the mutual funds and he wants to invest, he wants to get units. At what value? NAV at the time of investment, NAV at the time of issue. Later, when he wants to withdraw the money, when the redemption should take place, at what value unit should be replaced? The sale value for the investor, redemption value for the mutual fund. That value will be NAV. And this NAV should be published by the mutual funds on a daily basis. I showed you already in the websites and all, Value Research, their own website, Money Control, Morningstar, various websites. The NAV will be published on a daily basis. Mostly, some mutual funds will do it like a weekly or a fortnight basis, but mostly it is on a daily basis. Okay, how do we calculate that? Valuation. Okay, let me give you the format. So basically it is, we will list down all the assets, we will subtract all the liabilities, then we will get the net assets. You are future chart accountants. You know better than me how this structure works. But what is important is when I take the assets and liabilities, it should all be on market value basis. Don't bring in your prudence principle into consideration. Cost or market value, whichever is less. No, we don't do that. It is purely market value. So, what are the assets we have? Market value of equity shares, market value of bonds or debts. Then you will have cash or some accrued assets. Accrued assets like outstanding, you are investing in bonds. You are yet to receive some interest income like that. Okay, how to value equity shares? Market value will be straightforward, market value. But sometimes what they give you, they don't give you directly. In examination condition, I'm telling. They will give you cost of investment and they will give you index, that is Nifty, Sensex, at the time of investment and at the time of valuation. For example, they will tell you like this. You invested on 1/4/2021. Example I'm giving. On 1/4/2021, your investment, cost of investment, your investment value is, let's say, 120 lakhs. At that time, market index Nifty was trading at, let's say, 7,500. Now on 31st of March 2022, they will tell you index is trading at, or index value is 12,000. What is the investment value? So they will not tell you. You have to value investment based on index, but we have to assume, not practically, but for examination purpose. That is, we assume the way index has been moved, in same proportion, your investment also will move. So 120 lakhs into 12,000 divided by 7,500. So whatever the amount comes, that is what we are going to take it as market value of equity shares. So if you want to write a formula, in case not given, if they give you market value, you take it. In case not given, then we are going to write the cost of investment multiplied by index during valuation on the date of valuation, during valuation, or let's say the index on date of valuation, current date of valuation, divided by index during investment, during initial investment, index during initial investment. What is assumption? We are assuming that the proportionate movement of index is the same as your investments. Your investment is moving in tandem with market. For examination purpose, this is our assumption. Okay, bonds. How do we calculate bonds? If it is a, okay, bonds, we calculate as per valuation of bond. You know valuation of bond? Valuation or discounted at YTM. You know what is YTM? Yield to maturity. When you discount the cash flow, coupon and the redemption price using required rate of return, the present value is intrinsic value of the bond from an individual investor point of view. But if you discount the coupon and redemption price, if you discount the cash flows using YTM, the present value is market price, market value. So whatever the method we adopted in bond valuation, that method should be applied. Sometimes they will tell you unlisted. If it is unlisted, then we'll take it at cost, can't help. If it is unlisted, then we will take it at cost. If it is unlisted, we will take it at cost. And sometimes they will not give the maturity period. If the maturity period is not given, then how are we going to calculate? For example, they'll tell you, okay, cost of the bonds or cost of investment in bonds. Cost of investment is, let's say, 1 lakh. Then YTM during investment, current YTM, they say it is 8%. And expected YTM, they say it is going to be 7%. How are you going to value it? They will give you information like this. In that case, cost of investment 1 lakh. On that YTM, you are expecting 8% at present. That is your expected return. So what is your income per annum? 1 lakh into 8%, 8,000 is the current income. And in the future, it will be valued at 7%. So value of perpetual bonds, 8,000 is income divided by 7%. In other words, we can write whatever the bonds, cost of investments, the cost of investment, I'll write cash little bit below, cost of investments multiplied by current YTM, cost of investment multiplied by current YTM divided by future YTM or expected YTM. Current YTM can be coupon also if coupon rate is given. But denominator is expected YTM. Current YTM divided by expected YTM. If information available like this. Okay. Then regarding cash. Cash balance will be straightforward. Whatever is the cash balance. But sometimes what they will give you, cash balance, they will not give you at the end of the year. They will give you at the beginning, at the time of issue. From the beginning, they'll give the data. So you have to arrive at the cash balance. So what are the components of cash balance will be? It will be issue proceeds. From the beginning, if you calculate, issue proceeds minus investments. Once you receive the money, you are going to invest, minus investments. Minus initial expenses, because you have to incur issue charges, flotation charges, subscription charges, initial expense will be subtracted. Then you might receive some dividend, so plus dividend received. You might sell some investment, so you receive the money on that, plus sale of investments. And once you sell, you might reinvest some amount, so minus reinvestments or purchases, minus reinvestment. Once you sell, you reinvest. And then you might distribute some amount to the dividend for the unit holders, that is minus distribution of dividends, and I'll say CG, hope you understand, capital gain. If you receive dividend, some portion you might distribute. If you made capital gain, sale price minus purchase price, that also you will distribute. So I'll just read my handwriting. If cash balance given straight away, no problem. Otherwise, you have to do issue proceeds minus investments minus initial expenses plus dividend received plus sale of investments minus reinvestments, that is you reinvest the purchase price, cost of investments, minus distribution of dividend and capital gain, DIV distribution of dividends and capital gain. One more thing you should subtract, that is management expenses, recurring expenses, annual expenses will be paid. And this you should be very careful. They will give you date on 1st of April and valuation will be done on 30th of June. So they'll tell you management expenses 1 lakh per month. Some people take 1 lakh directly. Some people do 1 lakh into 12. Actually, the data is given on 1st of April and 30th of June. So only 3 months expense you should take 1 lakh into 3. So be careful about the time period involved. Next one is accrued assets. I hope you already written it down. That is always there. Accrued assets will be the assets. Liabilities, amount to be payable. You will have amount to be payable like accrued expenses, accrued management expenses. They might tell you 6 lakh is annual management expenses, out of which only 5 lakh is paid. So when you subtract from cash, you subtract only 5 lakh. You subtract only 5 lakh. But 1 lakh is still pending. That will be considered in liabilities. And then amount payable on shares. Amount payable on shares. Maybe partly paid up shares. Recently, Bharti Airtel has come up with a right issue where the shares are yet to be paid, partly paid up to make it into fully paid up. So some amount will be yet to be paid by the investor. So that might be liability. So we have all the assets, we have all the liability. That is all the assets, market value of all the assets minus liability will give you net assets. Again, remember, no prudence principle, no cost or market value, whichever is less. If unlisted one, because we will not have market value, we went for cost. But practically, like liquid funds, they do valuation MTM basis, mark to market. They do valuation YTM basis, MTM basis. But anyway, for exam purpose, if unlisted, we'll take it at cost. Okay, net assets we need per unit basis. So net assets, you divide by number of units, unit size, that will give you net asset value, NAV, net asset value per unit. Net asset value per unit, and this is going to be used if somebody is investing today. It is used for issue purpose, issue of units, and if somebody is withdrawing money, that will be for redemption purpose. So issue of units means this will be for investment purpose, and somebody wants to withdraw money, that will be uh, for redemption purpose, for redemption of units, redemption of units. So very important question in examination regarding NAV calculations. Now, in with respect to NAV, we have to understand entry load, exit load. We have to understand dividend equalization. Please remind me if I forget these two. I'll go for other calculations popular in exams, and then I'll come to those two areas. Entry load, exit load, then dividend equalization, and then we have two different returns. For mutual funds, we will have a different return, and for investor, we will have a different return. We'll analyze all those things. Okay. Hope you have taken it down. I'll erase it. Okay. Then again, back to the basic structure. Back to the basic structure? You have mutual funds, we have investors, and we have stock market. Now, investor give the money to mutual funds, and mutual funds give the money to market, invest in market. And at what price the mutual fund invests, the purchase price, sale price is the performance of the mutual funds. Return generated by the mutual funds like IRR. I'll forget for the time being. But what is the return for the investors is basically at what NAV he will invest and at what NAV he will redeem, right? That is its profit or loss, NAV during redemption, during investment. NAV during investment is the price at which you invest, and NAV during redemption is the amount which he gets back. Okay, so this NAV during investment, we will take it as P0. Price, we will take, I know NAV is not price, but effective that is a unit price, right, for investment. Number of units into the price per unit, value per unit, that is NAV during investment. So for return calculation purpose, return from investor point of view purpose, we take P0, and NAV during redemption, I will take it as D1. And during interim period, there might be some dividend also distributed by mutual funds. There might be dividends which are being distributed by mutual fund. Not dividend distributed by the mutual fund, okay? It's a dividend distributed by mutual fund to investors. So we have two types of investment here. One type is dividends not reinvested. This is one type of assumption possible. Another type we have dividends reinvested. Dividend not reinvested, dividend reinvested. Basic formula is this. Basic formula, returns will be calculated by P1, return for investor, okay, returns for investor. P1 minus P0 plus D1 by P0 into 100. I hope you are comfortable with this formula we have discussed in portfolio management also. P1 means your NAV1, P0, P1, I already showed you. You can do it at an individual basis or you can do it at a total basis. So, dividend reinvested, rate of return for investor can be calculated by same formula. I'll repeat, P1 minus P0 plus D1 by P0 into 100. This is per unit basis. Per unit basis. Or you can also do total value basis, meaning what? Value at the end minus value at the beginning. Don't write back end up, at the beginning, plus total dividend received whole divided by value at the beginning into 100. Also, I don't have space, you write into 100. So this is previously was per unit basis, and this will be on total basis. On total basis. This will be on total basis. You can do both this or this. Both answer will be same. Per unit basis you can calculate. On total basis you can calculate. Both will be same. And one more thing, if you want to annualize this yield, this is total yield. If you want to annualize, so whatever return you got, you should multiply it by 12 divided by M, 12 by number of months, or 1 by number of years. So that if this return is more than a year or less than a year, you can express on annual basis, annual yield basis. You don't have to go for 1 plus R method. 1 plus R, 1 plus R, that compound interest method, you don't have to go for mutual funds. If this return is for, let's say, 6 months, how much for 12 months? Into 12 by 6. This for 6, how much for 12? So you do into 12 divided by 6. If it is annually, this is for 5 years. How much for 1 year? You divide by 5 or into 1 by 5. So rate of return can be expressed in annual basis with simple interest. Don't worry about the compound interest much. That is additive model. You can follow it. Okay. Now, if you reinvest dividend, here is the important thing. Rate of return. Rate of return for investor. If you reinvest dividend, then per unit basis should not be done. Per unit basis, not possible. I'll give numerical example. You'll understand better. Per unit basis, not possible. On a total basis, yes, it is possible and it should be only on total basis. So per unit basis, not possible. And total basis, same value at the end minus value at beginning. Dividend will not come here. Divided by value at the beginning. Divided by value at beginning into 100. Into 100. Dividend, you will not take it here because dividend is reinvested. Okay. So once you've written, let's write the points. Okay. Please write the sentence. Or I'll explain, then you will write the sentence. See, in dividend reinvested, how many units you invested at the beginning and how many units you invested at the end are same only. I invested 1000 units. At the end also, I will have 1000 units. See, because number of units are same, I can do per unit basis or I can do total basis. Both the answer will be same. But when dividends are reinvested, means what? I invest 1000 units. On this, I get some dividend. The dividend, I will put it back. When I reinvest, I get some more units. For example, I had 1000 units. On dividend reinvestment, I'll get 100 units. So at the end, I'll have 1100 units. Beginning I had 1000 units, end I had 1100 units. Number of units are not same. So when number of units are not same, per unit basis cannot be done. That is why we have to do only on total basis. And also, how do you calculate the number of units? The dividend is the reinvestment made. That is the amount of reinvestment divided by NAV. Not at the beginning. NAV at the time of reinvestment, that will give you additional number of units purchased. And that additional plus beginning, that will give you value at the beginning. I mean, it will give you value at the end, number of units purpose. Okay, we'll do a small numerical. You'll understand. First, you write one small point. Small point. When dividend is not reinvested, 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 comma, the number of units at the beginning, number of units at the beginning as well as at the end, number of units at the beginning as well as at the end, as well as at the end remains same, remains same. Therefore, 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 yield can be calculated. Therefore, yield can be calculated on per unit basis. Yield can be calculated on per unit basis. Yield can be calculated on per unit basis. Per unit basis or or on total value basis. Can be calculated on per unit basis or on total basis or on total basis or on total basis. Both will give same answers. Full stop. Next sentence. Both will give same answers. Both will give same answers. Both will give same answers. Next. Next sentence or next heading. When dividend is reinvested, when dividend is reinvested, when dividend is reinvested, number of units at the beginning, number of units at the beginning and at the end, number of units at the beginning and at the end, and at the end will not remain same, will not remain same, will not remain same, will not remain same, and hence per unit basis is not possible. Per unit basis will not possible. Per unit basis will not be possible. Per unit basis will not be possible. Okay, next sentence. Additional number of units obtained. Additional number of units. Additional number of units obtained can be calculated by additional number of units obtained can be calculated by dividends dividends received, total amount dividend received divided by NAV during reinvestment. NAV during reinvestment. Dividend received divided by NAV during reinvestment. During reinvestment. You understood? This is the additional number of units. What you had initially plus additional that will be used for value at the end. And also dividend received will not come here because this is already represented in this additional number of units. So at the year end, we have number of units which will include additional units purchased. So there the value of dividend is already there. Again, if you take dividend, that amounts to duplication. So that should not be there. And also, please write down this return for investor here into 100 into 12 by M. Please make sure you write this into 12 by M for annual basis. For annual basis. Okay. This is the structure of it. When you do numericals later, you'll understand better. But if you have any doubts conceptually, get it clarified. Okay. Hope you have taken it down. Some ratios. These ratios we already discussed during portfolio chapter. I'll discuss once more. Ratios. We have actually four types. I mean, one type is not asked in exam, so I'm not covered, but I'll just quickly cover it now. One is a Sharpe ratio. The other is a Trainer ratio. Then we have Jensen's alpha. One more we have Sortino ratio. Now, Sortino ratio is not very popular in exams, but I'll quickly tell you the formula. Practically, it is used. A Sharpe ratio formula is return of a portfolio minus the risk-free rate divided by standard deviation. That is risk to reward, reward to risk, or reward to variability. That is RP minus RF represents risk premium, and denominator standard deviation represent risk. So risk premium for 1 unit of total risk, reward to variability, that is Sharpe ratio. Trainer ratio RP minus RF divided by beta, reward to volatility, RP minus RF, that is risk premium for 1 unit of beta, risk premium for 1 unit of systematic risk. Sharpe ratio, risk premium for 1 unit of total risk. Trainer ratio, risk premium for 1 unit of systematic risk. Both higher the ratio, the better it is. And S for Sharpe ratio, S for standard deviation. Sortino ratio also follows similar one, RP minus RF, but he will use downward standard deviation. So what he says is, I will compute standard deviation only when the market is down. Downward standard deviation. It's a new measure actually. You would not have computed in statistics also. So basic formula standard deviation I'll use. But if market price is more, positive deviation I will not consider. Only when it is downward deviation I will calculate, and based on that standard deviation I will calculate. So risk premium for 1 unit of downward risk, not total risk, downward risk, that is Sortino ratio, and Jensen's alpha is return of portfolio minus expected return, that is minus EAPM return, that is called as alpha, the return generated more than what is expected. Anyway, I will not be doing problems on this in this chapter because I already covered in portfolio, but it's there in the syllabus in this chapter, so I am covering it quickly. Okay, so hope you are able to follow this. Okay, let me go next. First of all, you have to understand the return by the mutual fund will not be equal to return for the investor. Return generated by investor will not be equal to return generated by the mutual fund will not be equal to return for investor. Let me explain why. Question may be asked based on that also. Again, basic structure. We have mutual fund, we have investor, and we have market. Just an example you take. Investor invest, let's say 100 rupees. He gives rupees 100. Now, will mutual fund invest the entire 100 in the markets? No, they will have to subtract their fees, or initially will have something called as initial expenses. Suppose you will have initial expenses of 5%. Initial expense of 5%. So how much will be invested? For this 100 rupees, you will invest minus 5, only 95. You will invest only 95. And let's say from the market, you generate 12% return. Return given by market 12%. Return by market is 12%. So how much you generated? 95 into 12%, that is 11.4. 11.4. Now the question is, will you give entire 11.4 to investor? No, you will not pay entire 11.4 to investor. Then what is that? You will be subtracting recurring expenses, expense ratio, management expense that comes every year. So let's say recurring expense is 2%. Recurring expense is 2%. So how much will be paying it to him? You will not be paying entire 114. So on 95, you apply 2% expense. You subtract 95 into 0.02, 1.9. So if you subtract, what is remaining is 11.4 minus 1.9, 9.5. So what is the effective return? Effective for investor is 9.5. Effective return for the investor is 9.5. So in the exam, what they can ask you, what they can tell you, they will give you this 12%, they will give you initial expenses 5%, they'll give you recurring expense 2%, they'll give you these things, they'll give you 5, they'll give you 12, they'll give you 2, and ask you to compute this 9.5. And more importantly, in some examination question, they will give you what is the return expected by investor and ask you to calculate what should be the return generated by mutual funds from market. That also they can ask. Write down this example, then I'll give the formula for you to calculate the return expected by investor. Okay. So I'll give the formula. If you want, if they ask you this, what is the return or what is the return generated by the market, they will give you return expected by shareholder. Then they'll ask you what is the return that mutual fund should generate. For that, you can write on this formula: return to be generated by mutual fund from the market. Return to be generated by mutual fund from the market to meet the investor expectation. This is given by investors expectation, investors expected return, investors expected return divided by 1 minus initial expense, 1 minus initial expense plus recurring expense. Basically, denominator net investment plus recurring expense. Let's see in this example, will it hold good? Investor expectation is what? 9.5. No, I mean, 0.095. 0.095. 1 minus initial expense 5%. So 0.05 plus recurring expense. Recurring expense is 2%. So 0.02. Check it out. Will it apply? 0.095 by 0.95 plus 0.02. I think you get 0.12, which is what 12% the mutual fund need to generate. So please note it down, this example. Okay, I'll go further. Now let me talk about the concept of entry load and exit load. Entry load and exit load. There are restrictions by SEBI that you can charge only entry load or you can charge only exit load. Some percentage also restrictions are there. Basically, let me tell you the meaning of it. Entry load. Load means you take it as expense. So when I give some money to mutual funds, they will deduct some money, their commission, their expense, they will deduct. And they'll invest only the balance amount. So you can treat like a purchase commission. Exit load means when I sell, they will deduct the money and give me the balance amount. That's like a sales commission. Now, which is advantageous for mutual fund? Deducting the expense during investment or deducting their commission during sale. It's a very interesting one. During entry, if the mutual fund take their expense, they will get early. That is, they'll get commission at the beginning itself, at the time of purchase itself, at the time of entry itself. That's an advantage for them. But what is the advantage of exit load? You will compute the percentage on sale price. So if investor exits after 10 years, the redemption price would have been high. And on a higher value, if you apply percentage, your commission also will be high. But the problem is you have to wait till he sells. That's going to be a longer waiting period. Anyway, so entry load is basically applicable on investment issue of units. Applicable during investment, that is on issue. This is like purchase commission. Purchase commission. So this will increase the cost of investment. Ultimately, this will increase the cost of investment. Whereas exit load is applicable during redemption. During redemption, that is during withdrawal. And this is like sales commission. Sales commission. And this will reduce the net proceeds. What was amount supposed to come to you? It will be reduced. So it will reduce the net proceeds. So here the formula is given by offer. No, this is at the time of issue. We call it as public offer price. Public offer price is given by NAV divided by 1 minus entry load percentage. Entry load percentage 1 minus. Why? If you give 100 rupees, they'll take out, let's say, 2 rupees entry load, only 98 will be reinvested. Only those number of units you will get. So public offer price into 1 minus entry load, you think like that. Public offer price into 1 minus entry load. That much only balance will be invested. That's why your cost will increase. Whereas redemption price will be NAV divided by 1 plus exit load. 1 plus exit load. Because redemption price includes the amount that you have to get it. I mean, NAV will include the amount that you have to get it as well as what is to be paid to the exit load commission. So both of them are involved in NAV. So it is 1 plus. So basically, redemption price will decrease when I do 1 plus, and offer price will increase when I do 1 minus entry load. Entry load is also called as front end load, and exit load is also called as back end loads, back end load. Okay, this is about entry load and exit loads. Let us go for one last topic of the mutual funds, that is dividends equalization. Dividend equalization. Okay, let me explain with the help of a numerical. I'll explain first, then you can take it down, then we'll write the summary point. First, understand. Let's say on 1/4/2018 is the beginning of the financial year, 31/3/2019 is end of the financial year. 1/1/4/2018 there were 1 lakh units with NAV of 20 rupees. Beginning 1 lakh units, 20 rupees NAV. And during half year up to 1/10/2018, you earned income of 5 lakh. You earned income of 5 lakh. And on 1/10/2018, at the beginning of the year, you issued 20,000 units. At the end of the year, I mean, other 6 months, after issuing 20,000 units, you earned 12 lakh. So, what's the total income? 5 lakh in the first half, 12 lakh in the second half, total income 17 lakh. And how many units are there? 1 lakh at the beginning, 20,000 you have issued, total 1,20,000. Now, if I want to distribute entire 17 lakh as dividends, now can I do 17 lakh divided by 12? Is it correct? Get the structure clear? You write it now. I'll give you 2 minutes. Along with the writing, try to think as well. On 1/4/2018, beginning, you had 1 lakh units. During the year, you issued 20,000 units. End of the year, you have 1,20,000 units. Beginning, during the year, end. Income in the first half, you had 5 lakh. In the second half, you had 12 lakh. So total 17 lakh. Now, can I do 17 lakh is the total income for the year? Let's say I want to distribute 17 lakh divided by 1,20,000. Can I say 17 lakh by 1,20,000? That is 14.17 rupees. 14.17 rupees. Can I say like this? Is it justified? Is it reasonable? It is not reasonable. Why? This income earned throughout the year, but these people have joined in the middle of the year. How can they be paid the previous year? I mean, previous period? So these people should not be eligible for the income earned earlier, right? Logic you are able to understand? People who have joined in between, people who joined in between should not be eligible for the income earned earlier because it is earned without using their money. They are not responsible. They should not be eligible. So they should not be given 14.17. They should be given only the income earned after that. Only that they are eligible for. Previous one, they should not be eligible for. How do we justify this? I hope you understood the process. What is the objective? People who have joined in the middle of the year, they are not eligible, should not be eligible for the income earned earlier to them joining. So what do? We do this. You are eligible only for 12 lakh. We will give it to you only that. But we don't do that. What do? This 5 lakh income earned earlier. No, that you pay now. That 5 lakh which earn when you are not there. So when you come, you pay for that also and come now. So that you are on par with existing unit holders. And later, I will give everybody same thing. So earlier you paid some money, now you get back some money, so it is justified. A similar concept was there in bonds, in investment in your IPCC called as X interest, cum interest. Let me quickly revise that one. Let's say Mr. X on 1/4/2018 he purchased. He is a bondholder for a period of, let's say, 12 months, so 9 months, that is till 31st of December 2018. Let's say bond is 1 lakh and rate of interest is, let's say, 12%. So annual income is 12,000. So Mr. X transferred to Y on 31st December 2018. He became the new bondholder. On 31st of March 2019, when company pays interest to Y, company paying interest to Y, how much interest they will pay? Will they pay 12,000 or will they say, oh, you are a holder for 3 months, so we pay you 3 months interest? Company will not be worried about when did you purchase and all. They have a better job. They can't do investigation. When did you purchase? 3 months back or 2 months back or 2 days back? They can't do that. They will tell you who is the shareholder, who is the debenture holder on 31st March 19 as per our books, as per register of debenture holder, 12,000. 12,000 we are paying it to you. Amazing trick, no? Why? Having a holding period of 3 months, but he get for 12,000 rupees. You can use this to your advantage. What you can do, a day before 31st March, you can go and buy. You can get entire interest. You can think you are smart. But the person, Mr. X, who is selling, is he a bakra? Who is to invest for the whole year and sell 1 day before that? He is also smart. What he will do? When he is selling it to you, after 9 months, he will collect from you for 9 months due. 9 months means 9,000. Interest accrued till date. Mr. Y, you became a holder today, but whatever interest accrued till date, you have to pay it to the seller. He is the holder for this period. He should be compensated. Now, effectively, what Y will get? 9,000 he will pay. 12,000 is going to get. So effectively 3,000 is his income. That is what exactly happening in dividend equalization. How are we going to calculate now? Same thing. How much income earned per unit basis? 5 lakh income earned by using 1 lakh units. So 5 per unit. So mutual fund will collect this 5 rupees from these 20,000 people. Later, we give everybody the dividend, they will be rightly compensated. So these 20,000 units people, they should also pay 5 rupees. So they should pay you 1 lakh rupees. So how much surplus will be available with the mutual funds now? 5 lakh plus 12 lakh, 17 lakh income plus 1 lakh dividend equalization received. So they will have total 18 lakh. Now this 18 lakh will be divided by 1,20,000 units. This will give 15 rupees to everybody. Is this 15 rupees justified? Yes. How? Observe. Earlier what was this people earned? 5 rupees, right? 5 lakh by 10,000, 5 rupees. In the second half, how much is earned? Second half, 12 lakh income by 1,20,000 units. That is 10 rupees. So 5 rupee per unit earned in the first half, 10 rupee per unit earned in the second half, total 15 rupees. What about the second set of people? You receive 15 rupees and you paid already 5 rupees, right? When you enter, you make a payment of 5 rupees. Effectively, what is your income? 10 rupees, and that is what you're eligible for, 10 rupees. Correct? So we'll write sentence also, and effectively what is that is going to play in our calculations, we'll write. First you complete this illustration. Any doubts, get it clarified. Then we'll write one or two sentences. Okay, hope you have completed. Let's write the sentence. Give the heading, dividend equalization. Let's write some sentence. Dividend equalization refers to, dividend equalization refers to, dividend equalization refers to, refers to amount collected by mutual funds. Amount collected by mutual funds. Amount collected by mutual funds at the time of fresh issue. Amount collected by mutual funds. Amount collected by mutual funds at the time of fresh issue. At the time of fresh issue. At the time of fresh issue. During the year. At the time of fresh issue. During the year. During the year. Equivalent to. Equivalent to. Equivalent to income earned. Income earned. Income earned. Equivalent to income earned before the issue. Income earned before the issue. Before the issue. Okay, that's all sentence. So, NAV during issue will be how much? Or let's say public offer price. Public offer price for new investor. For new investor will be NAV plus dividend equalization. And if you had any entry load, that will be added plus entry load. You have to pay, your cost will increase. Whereas redemption price opposite. Redemption price for people exiting during the year, that is for existing investor withdrawing. For existing investor exiting, withdrawing. Existing investor withdrawing, that will be NAV plus dividend equalization, not minus, plus dividend equalization. Why? Because when they are unit holders, income was earned. When they are unit holders during the year, income is earned. So when they exit, they should be given. So NAV along with dividend equalization minus exit load. minus exit load. If I take NAV at the beginning, I'll also take the income earned, whatever cap portfolio appreciation. Anyway, those things when I take a problem, we'll understand. So entry load, exit load are opposites, plus minus for buy sell. But dividend equalization in both the cases you add. When you buy, your cost price will increase. When you sell, your sale price will increase. So dividend equalization in both cases are added, whereas entry load is added, exit load is subtracted. Just be very clear. When you do problems, this will be useful. Okay. So this is the complete overview of mutual funds. If you have any doubts, get it clarified. Otherwise, we'll stop it today. And next session, we will be taking the problems. Okay. I believe no doubts. So we'll stop at this point today. I mean, this session.